Hello, today is Thursday, August 20th, 2020. I'm Joe Schmidt from TC2, and this is Staying Connected. A few weeks ago, we recorded a two-part podcast with a couple of my colleagues, Pat Gilpatrick, a fellow director here at TC2, and Laura McDonald, a partner at LB3. And we discussed what companies should think about in the IT and telecom space if you're anticipating or in the midst of a merger or acquisition event. On today's podcast, we want to elaborate on that IT M&A focus, but this time look at what new management or new private equity investment teams need to do to understand what they have inherited and how to derive savings, which is usually one of the main goals of mergers and acquisitions. Pat and Laura, welcome back. So, Laura, once all the legal hurdles are behind them, what recommendations do you have for a new management team with a newly acquired company as it relates to IT and telecom?
Thanks, Joe. New management and private equity investors have a lot on their plates with regard to a merger, acquisition, or an investment in a company. And their priorities are to hit growth, top-line revenue targets. But there's also a necessary focus on reducing operating costs and improving the bottom line profitability. The telecom IT space is an opportunity to reduce those operating costs. In particular, businesses that have a high percentage of telecom or IT spend, such as those in the financial services, insurance and professional services, particularly with those with multiple office locations, and retail may have significant cost savings opportunities. But in most cases, in all the sectors, savings are usually available, but you have to know where to look and how to proceed. In short, operational synergies and additional cost savings are often found, particularly if the company has not done a recent RFP or begun or looked into migrating to newer technologies.
Okay, Pat, how do they start?
Well, Laura, you are absolutely right. If a company has not shopped for services for a while, we've seen in some cases upwards 30 to 40% savings available to them if they haven't taken advantage of the marketplace recently. But first, they need to identify their highest priority projects, of course, and what technology or communication needs are associated with those. And then based on future requirements, they need to identify any gaps between what they've inherited and what they'll need. Existing contracts have to be reviewed to understand whether there are any services or locations that are not already covered in the scope of the current agreements as well. And this involves many of the same steps we covered under the previous podcasts, which is to evaluate the providers, their current services, their contract expirations, how they're performing to any of those obligations, and what options might be available by the time they reach the end of their agreements.
Although you may be surprised to hear this from a lawyer, it's not just the contracts you need to review. It's very important to identify any negotiating leverage that you have or can create with suppliers. There are several ways that you can create or find this leverage. First, do you need new services? Providers are always eager to have new business, particularly if it's viewed as a new win or a higher profit. Second, use your history. Private equity firms may have knowledge of other companies in their portfolios who have more advantageous terms or pricing from the same suppliers. New management can bring in their past experience, subject, of course, to confidentiality restrictions, and now I am sounding like a lawyer. You can use that to your advantage. Third, use the power of the portfolio. If the provider thinks this may create opportunities at other portfolio companies, this may help in getting the deal done for an individual company. Caveat, each company has its own unique circumstances, so one size won't fit all. You can't force fit the same deal or even the same prices. However, all providers are looking for high-level introductions to new business, and everyone is looking to do a deal efficiently. Fourth, if there are multiple suppliers, then you can build a competitive dynamic between or among them. And then finally, use the new card. You only get it once, but this is a perfect opportunity to say, we have new management that's tasked us with understanding what we need, what we have, how we can gain savings. What can you do to help? Sometimes this will generate immediate offers of cost reductions, particularly if the provider knows it has been overpricing the services. Be wary of these offers because they're often signals that there are additional savings available. And in building your leverage, you'll want to determine what is the best long and short-term path.
Okay, Laura, I get that leverage. And particularly when it comes to new services that are needed. So those services that they can go out and buy. But Pat, are there any other short-term ways to address the pressure to realize post-merger cost savings?
Yes, Joe, absolutely. In telecom, there are several places that they can look for quick savings, what we would call low-hanging fruit. Following an inventory of determining what you have, focus on services like audio and video teleconferencing. These are legacy services, and they're still in place, and they're very expensive to operate and can be easily migrated to something less expensive. With the advent of Skypes or Teams, cloud-based WebEx, or even public platforms like Zoom, they can be quickly eliminated or optimized. Same can be said for local. Local services like landline phone lines features can be minimized quickly to keep only what you might need for 911 type services locally. Wireless contracts can be renegotiated fairly quickly based on perhaps a larger combined device count with new and more cost-effective usage plans.
And keep a lookout for legacy data services, which are unlikely to be cost-effective. For example, we've seen some clients, believe it or not, with inventories of DSL local services or frame relay ports that they've never migrated to internet or MPLS, or sometimes they don't even use, but are still being billed for. These can be quickly eliminated or upgraded to much less expensive technology. Any point-to-point private lines that have been in the ground for over 2 years, they're not going to be competitively priced, especially given the market options for Ethernet connectivity. And any individual circuits that have expired circuit term plans can easily be recast for lower rates if you know that you're going to need them in place for at least 12 months.
That all makes perfect sense. Another area to research would be any data services that are in place at speeds or locations that may not have been added to the contract since it was last negotiated. If operations order a new speed or a port in a new country that may not have originally been in scope for the agreement, it's often billed at some more standard rate, which is very high and not commensurate with the other rates in the contracts that were pre-negotiated. These anomalies can be addressed with very quick amendments once they're identified as necessary service going forward.
Pat, that is absolutely spot on. I just saw a contract that had the list price for a component at over $1 million a month, but the actual discounted price to the customer was under $10,000. You don't want to be paying the list price.
These are all good ideas to address short-term fixes for cost savings, but what does the new management need to do in the long run?
Excellent question, Joe. They should set up a roadmap based on new technology requirements, their products, and organizational goals. There should be a 1-year plan to try and quickly address the new service requirements and the cost savings from the low-hanging fruit that we just mentioned. And they also need to focus on this as to what their positions are for technology migrations, if appropriate. Concurrently, there needs to be a 3-year plan to provide for identified technology evolutions based on the fully optimized operation, headcount, and end-of-state geographic footprint, because all of those are going to be in flux in the first year or so. And of course, right now, any plan has to use a crystal ball to try and determine how this pandemic is going to impact future office space, teleworking, manufacturing needs, cloud, and IoT opportunities.
Yeah, Laura makes a really good suggestion. A short-term plan and a long-term plan are both essential, and they need to work together. Your short-term plan savings shouldn't handicap your ability to create a longer-term save and optimization. For example, if your incumbent vendor comes and offers you 5% off the top savings, that's great, but make sure it doesn't come with strings attached like a long-term commitment or some kind of exclusivity that would interfere or hamper your 3 to 5 year longer-term plan. Also, be realistic about the timelines. You can gain savings and leverage moving to, let's say, a new SD-WAN environment, but that takes much more time, planning, in the best of worlds, an RFP, and then time to migrate or implement. New Ethernet connections in some cases can take 2 to 4 months. But once you have that new environment in the ground, if done properly, you can do rate optimizations or reviews on a regular basis to avoid costs getting out of the market and maintain your efficiencies. As I mentioned before, we've seen competitive RFPs bringing savings of at least 30 to 40% if the client has maximum competitive leverage.
Wow, Pat, that's a lot of bottom line savings, and it's good to know. One final item to consider to go to those bottom line opportunities, bill review. When you conduct your inventory review, I suggest doing a comprehensive review of your invoices. This is a good way to cross-check your inventory. And frankly, billing errors are rampant because many contracts have time limits on how long you have to contest an invoice and go back and recover over billings. The earlier you start this, the better. These reviews are often fruitful even if the enterprise has a telecom expense management system in place, a TEM, and can generate big credits and ongoing savings. I have seen stats claiming that 85% of the telecom IT invoices are not fully audited and claims that invoices can contain 12 to 20% in errors, and those are usually in the carrier's favor, not the customer's. This error rate is consistent with what we have seen as well. And remember, audits can generate both short and long-term savings, the credit up front and then the lower invoices going forward. Thus, if you don't have a TEM, consider getting one for the day-to-day stuff. And even if you do have a TEM, take this opportunity to do a deeper dive into your invoices. And if you want more information on this, listen to the recent podcast by our colleague Teresa Knudsen and Julie Gardner for additional insight.
Okay, thank you, Laura, and thank you as well, Pat. Now, as you've just made clear, any new management team will have a lot of work to do to make sure that the merger delivers the value that they expect. So if you do have questions about what you need to be doing if you are the new management with a newly acquired firm, or you have other ICT lifecycle needs, feel free to contact Laura, Pat, me, or any of the LB3 and TC2 professionals that you work with by sending us an email or giving us a call. You can also stay current by subscribing to these Staying Connected podcasts, checking out our websites, or by following us on LinkedIn.